Welcome to part 2 of the video. We're going to keep talking about your mortgage payment. So interest rates are increasing. Why hasn't your mortgage payment increased? If you've looked at your bill or the direct deposit from your accounts, most of you are going to notice that your mortgage payment, your total monthly payment, has not increased even though interest rates have increased. And that's because you have one of these mortgage products that we're going to talk about here. So variable rate mortgage is one where the interest rate changes with the market, but the monthly payments are always the same. And if your monthly payment hasn't changed, guess what? You have a VRM, a variable rate mortgage. Okay? Sarah likes it better because her monthly payments will be predictable and she won't have to worry that if interest rate increase, her payments will suddenly increase. This is something that she needs since she's on a fixed income and can only pay so much per month towards her mortgage. Okay, whereas an adjustable rate mortgage is one where monthly payments can change as interest rates go up or down when the interest rate changes. So if the interest rate goes lower, then the monthly mortgage payment will be lower too. But if interest rates go higher, then the monthly mortgage payments will go higher too. So far, I'm going to make this bigger. So far that we've noticed that TD, RBC, and CIBC mostly have, or our clients mostly have VRM, variable rate mortgages with TD, CIBC, and RBC, and clients with Scotiabank generally have adjustable rate mortgages, and their payments have been increasing as rates have been going up. So what does that look like on your actual payment? So on a VRM, if your payment is $3,000 a month, and let's say you started out at 3.5%, well, it may have looked like something like this, where most of your payment is principal and a small portion is interest. And if you're on a VRM, the monthly payment has stayed the same VRM, I won't write this, but VRM the same, okay, and the payment stays the same, more principal, less interest, and as rates have increased, let's say it goes to 4, the interest portion gets bigger and bigger and bigger, okay, and it's going to continue to increase until your interest payment becomes more than the actual payment, and then you'd have the trigger payment that we talked about in the previous video. If you didn't watch the trigger payment video, please watch that one to understand that fully. Whereas, let me get rid of that. Whereas the adjustable rate mortgage, if you started off at 3.5% here and your interest portion was that much and your principal pay down was that much, which is great, at $3,000 a month, as your interest rate increased slowly as it has been over the last several months, this payment is going to adjust itself higher, okay? It's going to adjust itself higher to ensure that this portion stays the same, that the same ratio of principal and interest continues to be paid. It means that you're going to continue to pay down the same amount of principal in each payment as you were before, even though rates is increasing. And to achieve that, the actual payment has to go up because there's more interest in that monthly payment. I hope that makes sense. It can sound a little complicated, but if you play with it a little bit, it's going to make sense. What you have to realize is with the VRM, a variable rate mortgage, the payment stays the same, and there's more and more interest. More and more interest is paid in your monthly payment as the rate increases. Okay, whereas the adjustable rate, the same amount of principal and interest the proportion is going to be paid. What's going to change is the amount of your payment in order to keep that balance as rates increases. Okay, so clear as mud, I know. If you need more clarity, drop a comment below and we'll continue the conversation. Okay, but if you get this, it's important to watch the trigger payment video so you get the other picture and what the risks are of having a VRM, and talk to your advisor, a good one, about what to do and how to invest, how to refinance during a period like this so you can screw up good deals as prices fluctuate lower to account for the higher interest rates. Okay, talk soon everyone.